Hi, welcome back to Tab U. My name's Katrina. I'm joined by Nick, Danny, and Darren from Life Financial Solutions. You guys want to introduce yourself? Nick?
Sure, I'll go first. My name's Nick Russell. I'm still the sales director, and today I'm repping our new merch.
Danny?
Danny Sovic, co-founder and director of Life Financial Solutions.
Darren Margolis. I run the protection department at Life Financial Solutions.
Great. It's the same format as last time. We're talking about mortgages and protection this time, and we'll kick things off with question number one, which is, what is a mortgage?
Mortgage is essentially a loan secured against a property.
Have you heard that somewhere before, please, Danny?
Never heard that in my life. It's a loan secured against a property, typically medium
Please check
to
episode
long.
1.
It's typically a medium to longer term loan to allow someone to acquire a property or raise money against a property.
And your role at Life Financial Solutions is a mortgage broker, is that correct? And what's the purpose of
Okay,
that? How does it
so
work?
yes, I'm a qualified mortgage advisor, director of the company, but I specialise in property finance. Mortgage is a big area of our business, and it equates to quite a significant amount of lending that we do within the business. We have a number of different clients, which I know we're going to touch on shortly, from personal to business, etc.
Great. And
Can I just jump in?
Yeah.
Because I think we might miss something here, and I think it might be interesting for any younger listeners or people wanting to get into the industry. You said qualified mortgage broker. It's probably been a long time, Danny. Can you take us back to what actually that means in terms of how you become a mortgage broker and what you need to do to qualify to become a mortgage broker?
Okay, so you don't necessarily need experience in the industry. I came from actually a lending underwriting background, so for me it made sense to make that transition to be a mortgage advisor, for me to be able to look at a loan from the front end and the back end. But to be a mortgage advisor, actually, you could jump straight into the exams, which is called CMAP, Certificate of Mortgage Advice and Practice, which ultimately gives you FCA-regulated qualifications that allows you to advise in mortgages, protection, and insurance. You can take courses, you can do a crash course, you can just buy the books, and then it's it's an exam-led qualification.
Typically, how long would that take someone on average?
Depending on how much you want to study, it should take 3 to 4 months, I would say. Some people might take 6 or 7. Some people could do it quicker.
Okay. Thank you.
Cool. I was just going to ask kind of how does mortgage work for individuals versus how they work for businesses? What are the differences? And, how can one protect both an individual mortgage or a business mortgage? If that's...
Okay, so yes, you can borrow money against a property if you're an individual, if you're a business. So if you're an individual, if you're buying a property to live in, you would typically do it in a personal name anyway, for many reasons. And then if you're buying a property as an investment, you can buy it in a personal name as an individual or with partners, however you want to go about it, or you can own a property in a business. If you're owning a property in a business name, depending on what it is, if it's a buy-to-let investment, then it tends to be an SPV, a special purchase vehicle, which a lot of people are doing these days for tax advantages. The key difference really is taxation, is one of the main benefits to having a property in a business, or it could be a commercial property, where if you're a trading business, you want to operate your business within that premises, then the chances are you're going to own that in a business name. Does that answer the question?
Yeah.
Yeah.
Yeah. And we're going to touch on kind of protection of mortgages.
So, obviously, with a mortgage, the feeling or the logic is that mortgage needs to be repaid, and if there is a mortgage on a person buying a home, if they were to become ill or pass away, that mortgage needs to be repaid. There are some lenders that, want that done, and not as a term, but they would be more comfortable. And I think that's reasonable to make sure. With a person, husband and a wife, buying a property, all you would do is you would put a policy in place in line with that mortgage for the term. So if it's a 25-year mortgage on a repayment basis, which is, Danny will know about, which is obviously whereby you make dents into that mortgage each month until there's nothing left. You would have a decreasing mortgage, so the mortgage decreases, the cover decreases in line with the mortgage, and you would want to have that in place on two very morbid kind of circumstances: passing away or becoming ill. And what you would do is you would set that up, and that would cover the mortgage. Obviously, not to get into too much detail, but there are other things you may wish to protect. You may want to leave the wife or the husband with a lump sum so that they can look after the kids. It's just a question of every mortgage is different. Everyone's circumstances are slightly different, and it's finding the right level of cover with the right provider, and running the two side by side. There is a direct link between mortgages and covering these, which is, I suppose, why we work together, I guess, is the reality.
Yeah, I think that if I can add to that,
Yeah, sure.
I think there is this general myth or perception whereby someone thinks, well, take a husband and wife scenario. Husband passes away. They think it's okay, wife can afford to just carry on making those mortgage payments. And even if they can, lenders won't typically allow that. They would typically reassess that individual to make sure they do have the worthy credit, the amount of income that they need to be able to support that loan. So Darren would always make sure within the department that we educate our clients to ensure that they understand that actually in that scenario it's not that simple. The lender won't just say, go on, you carry on, we sympathise. So therefore it's imperative that
Absolutely.
There's something in place so wife can have that debt paid off or vice versa.
And I think if you take it slightly further, someone has a 20-year or 30-year mortgage, you need to review that the cover is in line, because obviously with you guys, the rates end and you change things slightly, or people borrow money, and the cover needs to be in line with, how the mortgage or how your status in life is. And we typically review these things every few years just to make sure things are, in sync, because things change. Someone has a baby, or they get married, or obtain another property. It has a net effect on what you can and can't do, and that's it's just a great reason to have a conversation with the client, even if to say, yes, everything lines up beautifully, and let's pick it up again in a couple of years or whatever it is. So it's just
Does that happen frequently? That everything aligns nicely?
Yes and no. It depends. I mean, typically where things change is when you have these markers in life: marriage, kids, inherit some money. There are things which should get your brain thinking, I need to review my circumstances, change of job, losing benefits, getting new benefits. So there is always something, I suppose, to have a conversation about, but we don't need to reinvent the wheel. I mean, if it sits nicely and it works,
Keep at it.
absolutely keep at it. But we'll obviously advise the clients accordingly, and they will normally take that advice because it's researched and it's done, to suit their needs at the time, with the proviso that let's constantly look at these things 2 years, 4 years. It just depends. You make markers of these things.
Perfect. Well, that's great. We'll move on to question number 2, which is, how much can I borrow for a mortgage? And this is 2021 July.
That must be the most common question you get from a client. How much can I borrow?
Yeah. Oh, I need a mortgage. What's the interest rate? I get that quite a lot. Okay, so it's very dependent on whether you're buying it to live in or you're buying as an investment, as a buy-to-let. So the principles are the same. So borrowing capacity, if you like, is broken down into 2 areas. It's initially income-led, and then it's capped at loan-to-value. So if you're buying a property to live in, or you're remortgaging the property that you already own and you want a capital raise on the property that you're living in, it's essentially going to be focused on your personal income. And every lender has their own affordability calculation, but typically they would work on a capped income multiple of around 5 times. And then you have your loan to value limitations, which could be 90%, which could be 95%, depending on the lender. For a buy-to-let investment, it's rental income focused, so lenders will stress test rental income. And that stress test formula is slightly different across various different lenders, but they all follow the same principle, which is typically led by whether you own it personally or whether you own it in a limited company name. You tend to find that borrowing power, if you like, is stress tested more favourably with limited companies because of the tax advantages. And then again, you're capped at loan to value. So even if you got phenomenal rental yield on the property, which based on a lender's of stress testing calculation could give you 100% lend, you're still going to be capped at, well, these days lenders will go up to 85%, but more often than not 75%.
Well, let's just talk on the subject of mortgages. There's two aspects at the moment for me. Is rates are ridiculously low. I mean, I don't think we've ever seen rates this low in our lifetime, for one.
Agreed.
And two, the yo-yoing of max LTV, because obviously where it was, then COVID, now where it is again, banks are getting a bit more bullish.
Yeah.
Do you want to just talk about sort of what's happened over maybe the last 2 years, how the market sort of yo-yoed or dipped up and down, and just the dramatic changes were probably around COVID in the last couple of years around mortgages?
Yeah, do you know what? Even when the Bank of England was at 0.5%, everyone was jumping up and down saying this is the lowest it'll ever go. It's ridiculous. You know, I've been in the industry for almost 20 years, and I remember when the Bank of England rate was, 3-4%. Obviously, it's dropped significantly now. But actually, the rates are ridiculously low, but at a certain loan to value, at a certain risk. So I've got clients that are currently sitting at 85%, 90%, or are coming to me thinking I'm going to get the most phenomenal rate. But in a strange way, those rates have actually gone up. So what lenders are doing is they're passing on the low rate, but only to what they perceive as the lower risk clients, which is typically anyone under 80% loan to value.
Okay.
They don't really want the risk of over and above that. So there has been a massive yo-yo effect on loan to values. When we hit the pandemic originally, they're all capping their loan to values at 70, 75%. Slowly but surely, it's easing now. 80% is okay, 85%, 90%, and we're coming into the realms of 95 again. But they are ridiculously expensive still.
What at that level or that loan to value, or can you just talk about what the rates sort of looking like below 80 and what they're looking sort of in that 90, 95 area? Because obviously everyone's like trying to put as little equity as possible, right? Because who wants to tie all their cash up?
Absolutely.
But there's obviously that comes with a balance of, well, what am I going to pay for this every single month and my monthly liquidity?
There's a bit of a historic moment about 3 months ago when we all opened up our mortgage sourcing software. Suddenly we saw rates under 1%, 0.95%, and it was like, wow, it wowed the market. It was quite revolutionary. I would say that's typically up to 75%.
Yeah.
As you go over 75%, the rates start to creep up. I think if you're looking at around 80%, I think you're in, last time I checked, it was around in and around the kind of the mid twos, I would say. And then it starts to creep up when you go beyond that.
Right, so they balance those uber cheap mortgages with a significant jump once you take once they take higher risk, or what they perceive high risk.
Absolutely. Risk, like with anything, like with bridging as well, the loan to value is one of the key factors of risk, and then the interest rate will be dictated by that.
And one other thing, let's talk about multiple and income.
Yep.
Where are multiples right now than the amount you can borrow against your overall earnings?
What do you mean by multiple?
Well, there you go. I'm going to pass this over to our learned friends.
Okay, so income multiple. So to give you an idea, typically lenders will lend up to 5 times. Some will lend up to 5.5 times of income. So for ease of maths, you're on 100,000 a year. You could potentially borrow up to £500,000. So it's always been around the 5 times mark. That hasn't really changed dramatically. I think the only thing that's changed is twofold, really. One is how they're assessing that income. They're not as relaxed as they were. Back in the day, it was, if you're self-employed, they want to see your tax returns, what they formerly call SA 302s, or accounts if you're a limited company, or 3 months pay slips if you're employed. Now they're really looking deep into COVID effect. So if your latest tax return shows, the right amount of income to support the loan, they're now going to ask for bank statements to have a look at what COVID impact is, within your occupation that you're in. Pre-pandemic, lenders started to get closer to the 5.5 times multiple. They're still available, but they've relaxed a lot more. I would say the average is between 4.75 to 5, and there is the odd bank that will go to 5.5, but you have to be on typically 75 to 100 grand's worth of income. The loan to value has to be low, and that's quite limited in the marketplace. But they're also going to stress test your outgoings as well. So they're also going to look at, if you've got school fees and what you spend on bills and what have you, and that makes a big difference as well.
And are they taking into, so if you're moving property, look, if you get renew your 2-year, 3-year fix, obviously you don't really have to go through affordability because you're just sticking with the same lender and you show that you've made payments. If you move house, but you took a mortgage payment holiday, have you seen any effects of that from COVID mortgage payment holidays?
Not from a credit perspective. And that was quite key because I was probably like every mortgage advisor, I was bombarded with calls when mortgage payment holidays came out. And actually, it was quite disappointing how that was portrayed and how that was publicised because no one really knew the impact of it. Everyone, you know, I made it very, very clear to my clients that just ensure that you understand and that they categorically confirm this won't affect your credit. So it doesn't affect your credit, but what it does potentially do is it gives a perception to the lender. And automatically, if you took a payment holiday, you must have struggled in COVID. That's the perception.
Yeah.
So when lenders identify if you've taken a mortgage payment holiday, you need to evidence that you, A, are no longer on that holiday, B, are you paying that back on a monthly basis or has that been added to your debt? And there's no right or wrong answer there, as long as you're no longer on it, but also you need to prove that you've not been affected by COVID.
Fine, so you don't have any defaults on any other payments, on
Correct.
credit cards, and other things that may have impacted as a result.
Correct.
So
And
not
that's
only
when
did you take a payment holiday, you also couldn't pay X, Y, and Z. So you've had a serious detrimental effect, COVID, on what's happened in your overall credit file.
Absolutely. Look, I've had clients that took advantage of these schemes, very much like furloughing. I've had clients that run businesses that have furloughed some of their staff and no longer furloughed them. And they've had real challenges in getting lending, even on the basis of actually it wasn't them that was affected, but the perception of a lender is, well, if you furloughed a member of staff, then your business must have had problems during COVID. So therefore,
because those are the rules.
Yeah. And it's not always the case, but a lot of people took advantage of the scheme for the right reasons or the wrong reasons, really. So
also, some people might have done it in anticipation of problems and
Absolutely.
stem the problem before it starts. So who knows?
Absolutely, and that's actually we would say to lender, that's being a good business owner.
Prudent, yeah.
Is you've seen an opportunity to have a contingency in place, and maybe that person's role was redundant during that period, but it doesn't mean they couldn't carry on finding alternative ways to be efficient, right?
Yeah. Good luck telling credit that.
Yeah.
I was actually going to ask about kind of credit and if you can get a mortgage with bad credit.
Do you know what? I started the industry in the world of subprime, and you could literally have, millions of pounds worth of CCJ. You could have missed every mortgage payment for the last 12 months and you would get a loan. Hence why we hit credit crunch, right? Yeah. It went from one spectrum to the other. So post credit crunch, all of a sudden, if you had the tiniest of default, no one will lend. Slowly but surely over the years, that market started to relax now, and there's a number of lenders out there that will certainly consider adverse credit. It's all about the story. Mm-hmm. So why did that happen? It's all about when did it happen? Are you up to date now? The more significant, the higher the value in the credit, if you like, the more historic it needs to be. The lower the value in the bad credit, the more likely they are to be more lenient towards more recent issues. So yeah, there's a number of lenders out there that will allow you to get mortgages, but you have to be prepared that your loan to values are going to be a little bit more limited, and more importantly, it's going to cost you quite a bit more on interest rate as well.
Fine. Well,
if I can just reference how COVID, similar to how it affected the mortgage department, affected us. So a lot of people said to me, Darren, you must have been killing it. People must have been literally, dying to get cover.
Killing it is a choice word for your industry.
Mind the pun.
Not as much as you would think. What we found with COVID is that, so first of all, the premiums were not affected by COVID, which is possibly slightly counterintuitive. You would think that it's more risky. All that happened was that, first of all, when I was speaking to clients, the conversations were, if they were sort of unsure, were now a lot more relevant, of course. But the underwriting became very difficult because now there was a whole layer of COVID questions. Number one, have you had symptoms? Have you had COVID in the last month? And if you said yes to any of those, defer for 3 to 6 months, which I think is logical. But where it became really kind of interesting is when we were really in the eye of the storm, last year, they couldn't do medicals because nurses wouldn't turn up to your house and take blood from you. So what they did is there were two ways. Either they would come in full
Hazmat suits, yeah.
literally like, with gloves and masks and everything, which is slightly scary. Or they would send you a pack with some instructions to take blood from yourself. And what they would do is they would get a nurse to call you, and I had clients calling me saying, Darren, I've literally pricked all my fingers. I've got no blood left in me. I've taken 5 liters of blood, and it just didn't work. And it was
just imagining my wife asking my wife to take blood from me. Can you imagine?
No, it really kind of there was a panic reaction to trying to get, because everything was on hold for 2 or 3 months. But when they realised it was just completely ill-conceived and things opened up, they did it again. But I had a client phone me saying, he said to me, he said, look, I don't have any fingers left. I'm dehydrated. And I said, we'll hold on. But
did you get in cover?
Sounded slightly dramatic.
Say it again.
Slightly dramatic.
Yeah. So it's just crazy how these things change and how philosophies changed. And people who had certain conditions, now they were saying no cover. If you were slightly older, had a respiratory condition.
I was going to say,
absolutely.
Yes, if you had any underlying health issues that they would attribute to maybe causing greater harm or COVID being greater
open you up to being more susceptible because you had these things, they just said no. So we really had to be quite clever and try and work around these things. And we couldn't always, because if a guy has a respiratory condition or a blood condition as well, would you believe, older people, and it just became tricky. And then slowly but surely the philosophies changed. People living abroad, which ordinarily most providers will cover these guys, wouldn't do it, and some of them still don't do it because with the cross-border contamination. So, and it changes daily. I keep on getting updates and emails from providers. We are now back to pre-COVID underwriting, or we are almost back to pre-COVID underwriting, and it's you got to keep abreast of these things quite quickly.
What would be the advantages of obtaining an advisor versus not obtaining an advisor? And
okay.
Is it that? Well, yeah, I'll let you explain.
Okay, so I'll answer obviously from the mortgage perspective.
Go for it.
There's huge value, significantly value, and actually more so than ever during the pandemic as well. Going direct to a lender, well, firstly, how do you know which lender to go to? The amount of hours someone's going to actually have to go and search the market and source lenders, and the typical mentality is, I'll just go to, your Go Compare type websites and just search by interest rate, which is naive because, every lender has very different policy, very different criteria. The beauty about going to an advisor, there's so many different reasons. I think the key reasons are, well, firstly, us being able to understand the circumstances of the borrower and actually go to the right lender who is the right fit based on policy and criteria. It's then about sourcing the most competitive product, the product that fits that individual's criteria and circumstances. They also need to be able to get advice on what type of product. Is it a variable? Is it a fixed? Is it an offset? Be educated in those areas. How long do you want that rate for? 2 years, 3 years, 5 years? Identifying the mortgage term, what age they anticipate in retiring. Is interest only a better fit? Is repayment a better fit? It's an absolute minefield, and anyone that thinks they can go and do that, unless they've got a huge amount of experience, it's very, very difficult. But where, for me personally, other than the first part, which is the right lender, right rate, right product, it's then about how you go about approaching that lender, presenting the right story to the lender, making sure the lender understands the positives to a case, submitting an application, and actually getting it to offer an approval. And the value from our point of view, having been in the industry for a long time, is relationship as well. So if something happens, there's a challenge along the way, whereas a borrower going direct, they're going to ring that bank and speak to just anyone in a call center. We'll ring our relationship, someone we can talk to, someone we can level with, someone that's got some clout that can actually overturn a problem or see common sense to get that case to offer and completion. So they're probably the key reasons why there's huge value in what we do versus going direct to a lender.
I can actually testify. So Life have done my mortgage, and I had an issue when I was doing my mortgage, and had they not had that relationship with the bank, I don't think I would have got that issue resolved, and I was able to get over the line very quickly and it was resolved. So I can speak firsthand of the benefits of an advisor.
Absolutely. Relationship is definitely one of the key aspects, for sure.
Cool.
I could apply exactly what Danny has said to the kind of protection side. There is so much to be said for speaking to one person. You know, if you go direct, you may be passed around. You're going to have to wait on the phone. It is so important, especially when you're dealing with things which are, a mortgage is very personal. Protection is also personal. Dealing with medical disclosures and I sometimes know things about Danny's clients that he doesn't even know about because it's a different kind of approach and there's a different sort of set of questions. Um, you talk about relationships with your lenders. I mean, having done this for a long time, if I have a problem, I go to the top underwriter. I choose my battles very carefully, but certainly if they can make it work within their rules, they will. There is always they need to balance the kind of risk and the commercials. And if it's kind of on the cusp, and I can, and it's doable, they'll do it for us because, A, we write a lot of business with them, but B, I've spoken to these underwriters for many years, and I think I know when a decision is appealable. And normally I'm right because I do pick my battles, and it's not irrespective of the premium. We know what we're doing. I think the other thing on, pertinent to the protection side is trusts. We have to put these policies into a trust. Now, I'm not saying that the providers don't offer it, but I will. That's the only time I nag a client, and I warn them. I say, guys, it is so important to make sure that the policies are in trust, and I'll explain in a second what that means. And I make a note: 2 weeks, no answer, chase them again, and all my clients do trust because I drive them crazy, and they see the value in it. So, what is a trust? You may ask. So, put very kind of simply. When a person passes away, they have an estate, which will include properties, money they have, artwork, everything tangible. And before the money can go to the family, they need to get what's called a grant of probate, which is a legal document which makes sure that all taxes that should be paid to revenue and customs are paid. If you don't put a life cover policy into a trust, that forms part of that estate. So then you've got delays. That's number one. The other reason why you do a trust is that you list the beneficiaries, and we know clearly who the money goes to. And you have to, it's such a thing people miss. Practically speaking, when you're dealing with these things, it's a very emotional time. It's a traumatic time. You need the money. The husband needs the money so that he can continue, or the wife, or the partner, whatever it is. And we do it in 5 minutes. It's a form which we complete with the client. We get a couple of signatures. I can say very confidently that I don't believe that the direct providers will chase as much as perhaps I would. And it's because I feel so strongly about it. And to have a policy of £1 million, not have it in trust, and get hit at 40% when you've got £1 million mortgage is completely counterintuitive. So I think to me that's outside of what Danny said. I think those are hugely important reasons. There is a perception that going direct to the provider is cheaper. It's not always true. And even if not going to provider is slightly more expensive, the value and the time we put in and the constant reviewing and making sure everything is in line, I've never had a client say to me, "Oh, the difference. I don't see the value." It's just I believe in it very strongly.
I think as well we had a situation whereby we had a client that unfortunately had a policy, unfortunately passed away. And actually we truly believe that had that client claimed directly without our input, it would have taken weeks if not months, because there were challenges with the claim. But going back to what we spoke earlier about relationship, we were able to get hold of the top people within the provider who made sure that this claim went through quickly and efficiently. And the last thing anyone wants, when their loved one has just passed away and they've invested several £1000s in premiums, is to have problems with getting that money. So again, having an advisor actually pick up that claim and deal with it whilst they're grieving is you can't put a price on that.
Absolutely. And to the other connection that people sometimes miss is that often the husband or the wife or the business partner, they don't know these policies exist. Now, I can assure you that the providers will not come running for you to say, "Oh, you have a policy, I know someone." So someone needs to know where that is, and something that what we do is we make very clear that you have to have this conversation with your family. There is a drawer in the house, so everyone has, or the safe where these things are, and the line is that if something happens, everything is here, and they will know. Speak to Danny, speak to Darren, or whatever it is, and that's really important because I suppose everyone is so busy. Some partners don't know that their loved ones have got these policies, and if they don't know, they'll never know. So it's so important to make sure that the practicalities of how these things unfold are in place, and that's where we specialize, I think.
Cool. Well, I think that's answered that question. I will be getting one tomorrow.
Yes.
Maybe after this. Moving on to question number 3, which is, what are the challenges of obtaining a mortgage as a new business?
Personal mortgage, that is, yeah. As a new business owner.
As a new business owner, yeah.
Okay, fine. So, challenging is the answer. If you're a new business owner, then typically every single lender is going to want to see a 2-year track record, typically, which means 2 years accounts or 2 years tax returns, depending on how you structured as a business. A lot of businesses can make a loss in the first year, and that can be quite challenging as well, and that's quite normal. A lot of lenders don't like that, so it can be quite tricky. There are some lenders that do look at, very few, but there are some high street lenders that do look at 1 year's accounts. So ultimately, if you're a new business owner and you know that you're going to want to require a mortgage over the next 12 months, you've really got to follow your income during that 12 months. We always advise our clients that if you're starting a new business and you've got a planned move or a planned property purchase in the next 12 months, I ask my clients to sort of talk to me during that journey. Because like any business owner, when you go to file your first year's accounts, the first thing you're going to say to your accountant is, I don't want to pay any tax. I want this to be extremely tax efficient. And actually that can work against you.
Yeah.
So you've got to be quite careful to make sure, yes, you want to be tax efficient, but when you got your first year's accounts, you want to be able to show enough income. So the answer in short is you've got to wait a year, potentially. There are some scenarios where if you're a professional, if you're a solicitor, you're a doctor, and you spent many years practicing on an employed basis, and you then become an equity partner of that business. So you're effectively, in the eyes of a lender, if your shareholding is 15-20% upwards, you're deemed as self-employed. But there's some common sense there in that scenario where a lender can see that you're still part of that same organisation, so they would look at your historic income as well.
And will they take, so let's just say you get to your end of your 2 years and you then want first 2 years of business ownership, do they take everything into account? Will they take dividends? Will they take salary? Will they take, is it a whole plethora of how you earn will be taken into account?
Yeah,
do they average that out?
That's a really good question. So typically most lenders will look at your salary and dividends. Most lenders will do that. Some, very few, but some will take the most recent, which can be quite useful, especially if it's your first 2 years of trading. You'll typically find the second year will be stronger than the first year because of the investment into the business from day one. So that's where it's well suited. If you've had a good strong year in year 2, that you're going to be wanting to find a lender that will take the most recent. I then deal with a lot of business owners that don't want to take from their business. They're building a business. They want to keep cash reserves. They want to keep their shareholders' funds in place. They can continuously reinvest. And then they might have a nice healthy profit, but they might only take the minimum basic salary and they might take very little dividends. So we do have lenders that will actually assess their income multiple based on share of profit plus salary, as opposed to based on salary and dividends. And that's really useful for those businesses that don't like to take from the business.
And as a kind of new business owner, what kind of financial protection can I get, or what kind of advice should I be looking for?
So if you're a new business owner, depending on the setup, but the first thing that sort of comes to mind is to identify your key people, and to make sure that these key people, are protected. So it used to be called key man cover, but it is now key person cover, as it should be, being politically correct. Although if you look on some documents, it still references even today key man, which I find astounding. But either way, what you would do is let's say there's 3 or 4 people in the business. You identify the key people, and the logic being that if any of those key people fell away from the business by way of illness or passing away, what is the financial impact on the business? So unlike personal cover, where the cover is to protect them or their families, this is purely to protect the business. Now, with the new business, it can be a little bit tricky. You might need a little bit of a track record, to be able to establish that, for example, Danny's value to the company is X, Y, and Z. So you may need a couple of years of accounts just to be able to get a feeling for that. And you basically apply a formula, and whether you ask a lawyer, an accountant, or an economist, you'll get a different answer. But the company receives the money. And the logic is that in the absence of that person, they need to bring someone else in, they need to train someone else up, they may need to pay a recruiter, and you get to a figure. And then what you do is, as with personal cover, there would be the whole underwriting process. The difference being that the trust documents would be, for the actual company to be they are the beneficiaries of the policy, and that person falls away sadly. The money gets reabsorbed into the company, and then they can carry on. I think a lot of people often think that it's only the top people that are key, and what I've found is, you may have for want of a better phrase, a computer genius, a youngster who sits down in the attic doing stuff. Now, if he or she is absent, that may have more of an effect on the business than the MD, and it's about just trying to really get into the nuts and bolts of the business and how they operate and identifying these people. Another huge one is shareholder protection. So, for example, if Danny and I were shareholders in a company at 50%, if something happens to me and I pass away, in reality, my wife could march in to the boardroom on Monday morning and have a 50% shareholding and 50% voting rights, which is a real problem. Ideally, what
Danny
should
looks
happen...
frightened right now.
No, he's petrified. He should be. What you want to have happen is that, so for example, if the business is worth £500,000, we each have £250,000 worth of shares, you would have a policy that would effectively pay my wife £250,000. The money gets absorbed. The shares get reabsorbed into the company. Danny can carry on, functioning as a business and can, reissue those shares or however he wants. You'd be amazed how many problems accrue from these things where you have, and they'll often be referenced in the Articles of Association and the memorandum where there should be these things in place, and they're not. And as I say, to have a widow walk into the boardroom with half of the voting power, these businesses fold. Let her sail into the sunset with the money because that's what she wants. Let the remaining shareholders have those shares to do whatever they wish. And it's and I guess they could be, where it becomes very interesting is there'll be a key person and there'll be a shareholder. So you kind of just roll it into one nice neat policy. Those would be I suppose the only other one would be, is you can put your life cover through the business in a very, very tax efficient way. Dan, I was speaking about this earlier.
Well, we might, without that, I think this brings us on to the next question.
Okay, perfect.
Question number 4, which is what types of financial protection can I get? So if we take it from the business perspective and then individually.
Yeah.
With that, yeah.
So in terms of the business outside of the couple I've mentioned, what businesses can offer is, so obviously you guys will know that you can have sort of group cover where you'll have like 15, 20 people or 2 or 3 people, and there'll be a policy which covers them as a group, and that's quite nice. The difficulty with those is that they can sometimes limit you in terms of how much cover you can have. So typically you would have 3, 4, maybe 5 times earnings. Now, if someone is earning, say, £50,000, which is good earnings, £250,000 may not be enough to pay off their mortgage or to leave to their family. So another way to do it is you'd have a life cover policy. It's called relevant life cover, which would be paid for by the business. But the beauty is that it's not coming out of your post-tax earnings. So if you have your own policy and you're paying £100 a month, you would have had to have earned 140, 100, depending on your tax bracket. You would have to have earned and then get taxed on that. With doing it through the business, it gets written off as a business expense. There is no P11D implication, which is where there's a tax liability, and it's all put into trust. Again, you can see I love trust. It's all put into trusts, and the money goes to the right people. You are limited, in inverted commas, to taking those to age 75, because the argument is that by 75, people should have stopped working or would have stopped working. But it's huge. You save on the corporation tax. It is a fabulous way to have life cover in place, and all you have to be to qualify is employed. If you are employed, you would qualify for relevant life cover. I remember when they introduced it, maybe about 10 years ago, people were a bit cagey about how it would work and how HMRC would treat these things, but they pay out all the time, and it's something I push a lot.
We would challenge it, or accountants would challenge us a lot, wouldn't they? Saying, no, this is absolutely a benefit in kind. It doesn't make sense. You've got a life policy that's there to protect your family.
Yeah.
The business is trying to claim it back as a business expense.
How can it not be?
And actually, it's probably the only policy that's ever existed that where you're not taxed on the way in and you're not taxed on the way out.
Absolutely right.
And accountants would challenge us, and we would win, because that is absolutely the case.
And HMRC have it's been confirmed, so it's it's a really interesting one, a really nice one.
Cool. Well, I guess that's kind of covers the second question bit of what is the difference between income protection and critical illness cover?
So
maybe.
Yeah, I mean, I guess it's some people do get slightly. So income protection and critical illness cover people becoming ill as opposed to passing away. And what income protection is, as it says, is it replaces your income if you're unable to work due to illness or injury. So a typical example would be somebody has a massive heart attack and they are now off work for a year, for example, or even for 6 months. They may get some money from their employers. There may be a clause in their contract which says we'll pay you full pay for 3 months, and then it'll, statutory sick pay. What the income protection will do is, and it's linked to your earnings, they will pay you for as long as you're off work for, assuming that the policy is set up to circa retirement age, which it should be. I think it's hugely important. Unlike critical illness cover, which is a lump sum payout upon diagnosis of a specific illness. So with critical illness cover, you will have a list of 30, 40, 60 illnesses, depending on the provider. And if you become ill and your illness is on that list, you will get a lump sum payout. But as you can imagine, the income protection cover is you need to have both in an ideal world. And I'll explain why. I always use the example of a personal trainer. Okay, so if a personal trainer loses his leg and has a income protection policy and a critical illness cover policy, he or she will receive a payment, because losing a limb is a payment or a part payment, depending on the provider. And if he or she is now off work indefinitely or over a long period of time, they would receive their £2,000 a month, £3,000 a month, or whatever it is, until such time as either they do something else, or they return to work, or they get a prosthetic leg, or whatever it is. But for someone like, say, Danny and I, if we lost a leg, heaven forbid, we would be unlikely to succeed on an income protection plan, because the truth is, as difficult as it is, we could probably do most of our role without that, but a personal trainer couldn't. So the way to make sure that you hedge your bets, I suppose, is to cover both. And then, you're never going to, and far less likely to have an illness where you don't get a payout that way. So those are the main differences. And they work side by side. You also may have an illness which is on the list, but you're not off work because medical science is quite advanced and they can get you back to work quickly. So the two run side by side, and everyone should have both of them. And it's hugely important.
Interesting you say off work. Is that one of the key... am I right in saying that one of the key differences that with a critical illness, you could, in theory, be diagnosed with a critical illness and be back at work and you'll still pay out?
Absolutely right.
But with income protection, you you actually physically have to prove that you can't work.
Yeah, there is no lists of illnesses with income protection. The general definition is anything that renders you unable to conduct your own occupation. And if you cannot, and there are various tests that they apply, but if you cannot conduct your own occupation, then you fall under the heading of income protection. But as you say, someone could have a massive heart attack and be back at work in 2 or 3 weeks and claim on critical illness, and they may not need to claim an income protection. So, it's a heavy one, but it's
Yeah,
it
don't
is
ever
heavy.
really want to claim on that.
Yeah,
I'm
it's-
getting very scared that I have none of these. and
Moral
I'm
of the story,
thinking
don't
that
lose a
this is
limb.
really
Yeah,
bad
Yeah,
one.
don't lose a limb.
If we go on to final question, question number 5, which is how can financial protection help landlords and property investors mitigate inheritance tax liability? Ooh, that was a tongue twister.
So, obviously, in Danny's day-to-day, he deals with a lot of sort of landlords and guys who have property portfolios, and that, again, forms part of their estate. So when these guys sadly pass away, there is an inheritance tax on that portfolio. Typically, it can be up to 40%. So again, simple maths, if you have £1 million of assets, £400,000 of that could be taxed. And if your plan and you've worked your whole life to leave that to your family, it becomes counterintuitive. So what you would do is you would have a policy, a life cover policy, which pays that liability. So you would say, let's set a policy up for £400,000. Now, where it differs from sort of, other insurances, if someone has a mortgage and that mortgage is going to expire in 25 years' time, the term of that cover would be 25 years, right? Makes sense. But because no one knows when they're going to pass away, what you would do with sort of these inheritance tax policies is you would have them on what's called a whole of life basis, which means there is no expiry date. So whether the chap passes away tomorrow or in 50 years' time, whatever the pot of money is set at, that will pay out. They are more expensive by definition, of course, because they are a guaranteed payout. But what I often do is the conversation is, well, Darren, that sounds great, but when I'm 65 and I retire, I don't want to pay those premiums because I'm now retiring and I don't want to use up my pension, whatever it is. So my answer, and it's received relatively well, depending on who it is let the children contribute towards that, because ultimately they are going to be the ones who are going to be receiving the money less 40%. You can do it on an individual basis. You do it with a husband and a wife. There's no inheritance tax between husband and wife, but it's more to do with the kids and wanting to be able to get the full net value of these properties. Again, they're in trust. Of course they are, because how could they not be? Yeah.
Cool.
The theme.
Yeah, trust. I guess that covers everything today. If you guys have anything else to add?
No, I think both
Yeah.
you guys are great, very succinct. I think
Yeah, it's been
very
great
easy
to have you both.
understand. I think you did brilliant.
I've now got a long list of things I need to go and research and contact you guys for. But
Absolutely. Thank you very much for having us.
Thank you for having us.
Pleasure.
Thanks everyone for watching. That's been TabU, Mortgages and Protection. Make sure you like, subscribe, comment and share, and I'll see you next time. Bye.
Peace.